Hello, I'm Melissa Austri, and today we are talking real estate with a residential real estate company that provides a turnkey financial solution for homeowners by aligning them with other financial service partners. Joining us now is UT certified real estate agent and broker Glen Henderson from the Alliance Group. Thanks for joining us.
Hey Melissa, thanks for having me on today.
Yeah, well, before we go into your top 5 predictions for the housing market in San Diego, let's talk about your company, your business model, and specifically the turnkey financial solution that you provide.
Yeah, basically with Alliance Group, what we've set out to build and help homeowners with is not just getting into a home and helping them buy or sell a home, but helping them with overall home ownership and actually building a legacy. So when we help somebody purchase a home, we don't just get them into the home and say goodbye. We have an estate planner that we set them up with for a consultation so they can understand the importance of having a trust and how that protects them and their family. We set them up with a tax advisor that goes through and helps them understand the tax benefits of owning a home and how they can change write-offs, deductions, and different parts of it. We have an insurance specialist that they sit with. So then it's not just getting a policy, but reviewing everything to see if there's ways that they can save money or better protect their family. So there's a lot of things like that. Same thing with sellers and the 1031 exchanges and move-ups and analyzing their overall portfolio. So again, we just want to help clients not just get into a home, but actually understand home ownership and make sure that they're utilizing the home not just as a home, but as an asset and using it to its best advantage.
Good. So you're pretty much giving them the tools they need when they start this lifetime investment, which is a huge decision.
Exactly, because what we begin to see is nobody understood all these different parts of it, and without having somebody explain it to you and teach it to you, where would you? You wouldn't know it. So we're dealing with a lot of first-time buyers that they don't understand those things. So we realized, you know what, let's build a model, let's build a company that helps them with this and really helps them achieve all their goals.
Perfect. Okay, let's go. Let's start with predictions.
Okay.
So let's start with the first one. What's your first prediction for 2014?
So 2014, across the board, what we predicted is interest rates are going to continue to go up with that. So we have right here just a chart that shows some of the different big firms, Fannie Mae, Freddie Mac, the National Association of Realtors, Mortgage Bankers Association. Pretty much across the board, everyone's predicting by the end of this year, beginning of first quarter next year, we're going to see rates in the low 5% range. Now, we had already seen the climbs or the increase starting to take place. Fortunately, this week we saw a big dip with everything that's happening over in Russia right now and Ukraine. So for anybody that is looking right now, we have excellent opportunities, but because rates took a dip. But we are seeing the gradual increase in rates, and with the Fed continuing to ease their buying of the bonds, we know that by the end of this year we should probably be around that 5% mark.
Wow. Okay. So does that mean for people who are trying to buy a home, will that mean will lenders will loans? Will it be easier to get a loan, or does that?
It's not going to. If anything, it's going to make it tougher in the sense that as rates continue to go up, the amount that somebody can qualify for goes down. So if for every % increase in interest rate, it's about a 10% decrease in the amount that they could afford. So if somebody's looking at a $500,000 home, now they're only going to be able to qualify for a $450,000 home. And then with with appreciation going up, that makes it real tough. So it's going to price a lot of people out of the market or the homes that they want to be in.
Okay, let's go to this, and then your second prediction.
Yep, so second with that, as we know, or we're seeing already, is inventory is going to start to increase. And one of the reasons with that, we can see the trend from through last year going into the beginning of this year. We can see that we actually started to hit positive numbers as far as the available inventory. What it is that last year we had huge appreciation. And a lot of the homeowners that were either underwater or they were just at a point where they weren't going to make too much money if they sold their home. They didn't have a lot of equity there. They're now in positions where they have equity and they have the ability now to be able to sell, take some of that money, move up into another home, move to the other area, whatever it is that they're trying to accomplish. So we're starting to see a lot more homes coming onto the market this year. And we're going to expect to continue to see that trend.
It's a huge inventory, okay. Do a lot of the trends from 2013 kind of roll over to 2014? Does that usually happen kind of a a bit? Does that?
We're seeing a lot of different trends. Yeah, it's always changing. The real estate market is just kind of a roller coaster. It's always changing, and it's so you're always adapting with it, and that's why it's important to talk about what we predict and what we're seeing for this year. So anybody that is in the market is able to understand and kind of plan accordingly.
Yep. Okay. Let's go into the third prediction you have.
Yep. With number 3 is that appreciation is going to slow. And we're definitely going to see, and we're already experiencing this year, positive appreciation. But if you look at the chart there, you can see that where there's a big increase. That was through the end of 2012 and then going into 2013. Last year in San Diego, in some markets, we saw over 20% appreciation, which is just unrealistic. It's not normal. And it was because there was so much pent-up demand, and with the rates so low, it was a great opportunity. But that's tapered, and we're getting back into traditional appreciation. That's what we expect for the San Diego marketplace this year, is around 5%, which is still a great return. And that's what's normal, and that's what you should expect in a healthy market. The 20% isn't a healthy market. It's something you can't sustain, and that's what we were seeing in the mid-2000s, which created that big boom and bust. So.
Right. Okay, so now let's talk about the home affordability. What's going to happen with that?
Yeah. Unfortunately, with rates going up and prices going up, what it's causing now is the affordability in home ownership. We're going to start to see a decline. And you can see in that chart where it's at the very bottom, that's through 06, 07, when prices were at their peak.
Yep.
The home affordability in San Diego and across the country was low because of prices being so high. When the market crashed, home prices plummeted, you can see affordability spiked and it went up. Well, now as prices have come back up and we see the big increases, we're seeing rates starting to go up. We don't have jobs, we don't have people's income isn't growing at that same level, so the affordability is starting to decrease, which is going to start to bring down the home ownership, unfortunately. So where it's great to see prices and the appreciation, it also takes some people out of the market.
Right. And then your last prediction you have for 2014 is mortgage products. Yeah,
mortgage products. We're starting to see a lot more. Basically, portfolio loans is what they're called, where you have Fannie Mae and Freddie Mac are the big insurers or purchaser of the loans, and then you have the government loans like FHA and the VA loans, but that's about it. Now that the market's healthy, we're seeing positive appreciation and everything else. A lot of the smaller banks and financial institutions are creating what we call portfolio products, but they're creating their own loan products that don't get sold to the major organizations or financial institutions. So they're able to do things that don't fit into the typical or normal guidelines. For example, there's some banks we're working with now that have products where they don't just look at income and they don't look as much at credit, but what they look at is people's assets and net worth. And if they have a higher net worth and higher assets, they will qualify them based on that instead of their current income or past credit or things. So that's one example of products. So there's a lot of those that we're seeing coming back into the marketplace as it's become healthier and we're seeing the appreciation again.
So what advice do you have for people who are trying to buy a home or sell their home, for first people that, first home buyers and sellers?
For the home buyers, everybody we're talking with is, if you're thinking about buying this year, start the process now. At least start the conversations with the mortgage banker. Start looking at qualifying with it. Start getting an idea of the market you want to be in, because as we talked about, we know rates are going to be going up. So and what we mentioned here is, that 1% gain or increase in rates is 10% of affordability. So it could really take you out of a market that you want to be in, where you might want to be in, a North Park neighborhood. Well, you're not going to be in that neighborhood anymore because you can't afford there. So for home buyers, it's starting to look at that now. And then for sellers, we had a lot of people that we've been in conversations with, and because of what we saw last year in appreciation, what if we see 15%? What if we see 20% again this year? And we're explaining, we're not in that market anymore. That's past. And the market we're in now, as rates are going up and everything, take advantage of what you can get for the home now. And then especially for the move-up sellers, get your home sold and then get into your next property and lock in at the lower interest rate. Because if you wait till this end of this year, you might get a little bit more in sale price, but you're going to be paying more in your monthly payments because you're going to be buying a home at a higher rate and a higher price.
Really good information. Thank you so much, Glenn, for joining us today. If you want to reach Glenn or his team, you can reach him at alliancegroupre.com or at 619-500-3222.